Common trading myths persist not because they are true, but because they are comforting. They offer simple explanations in a world governed by probability, uncertainty, and delayed feedback. Trading literature written by long-term survivors consistently exposes the same pattern myths, thrive where discomfort is avoided. They promise control where none exists, speed where patience is required, and certainty where only preparation is possible. Debunking these myths is not about becoming cynical. It is about clearing mental space so that real skill has room to develop. One of the most enduring myths is that successful traders predict the market. This belief is seductive because it frames trading as an intellectual contest, a battle of foresight. In reality, profitable traders do not predict, they respond. They operate with scenarios, not forecasts. Trading literature makes this distinction repeatedly: prediction demands being right, response demands being prepared. Traders who chase prediction constantly fight the market when it deviates from expectation. Traders who respond accept uncertainty as the starting point and structure risk accordingly. The myth persists because prediction feels powerful, while response feels passive, yet only one is sustainable. Another common myth is that more indicators lead to better decisions. Beginners often equate complexity with sophistication, layering indicators until charts become unreadable. This creates the illusion of control while masking indecision. Experienced traders do the opposite. They remove tools until only what adds clarity remains. Trading books consistently show that confusion increases with information overload. Indicators do not create edge, they filter it. When too many filters are applied, opportunity disappears and hesitation grows. The myth survives because simplicity feels naive, even though it is often the end point of mastery. There is also the myth that trading more leads to learning more. Activity is mistaken for progress. Many traders believe that frequent trading accelerates experience. In practice, it accelerates emotional fatigue and reinforces bad habits. Learning comes from review, not repetition alone. Trading literature often emphasizes that fewer higher-quality trades paired with deep analysis teach more than constant engagement. The myth persists because stillness feels unproductive, even when it is precisely what allows insight to form. Another damaging myth is that a winning strategy eliminates losses. This belief sets traders up for disappointment and self-doubt. Every viable strategy includes losses as a functional component. Losses are not evidence of failure, they are the cost of participation. Trading psychology texts stress that traders fail not because they lose, but because they react poorly to losing. The myth of loss-free trading creates unrealistic expectations that sabotage discipline during inevitable drawdowns. The idea that emotions must be eliminated is another misconception. Traders are often told to become emotionless, as if detachment were the goal. In reality, emotion cannot be removed. It can only be managed. Fear and greed provide information about risk tolerance and crowd behavior. Profitable traders design systems that account for emotional responses rather than pretending they do not exist. Trading literature repeatedly shows that awareness outperforms suppression. The myth persists because emotional control sounds stronger than emotional understanding. Many also believe that a large account is required to trade seriously. This myth delays learning and excuses poor behavior. Small accounts, as discussed extensively in professional literature, are ideal training environments. They expose mistakes quickly and cheaply. What matters is not capital size, but capital management. Traders who cannot follow rules with small size will not follow them with larger size. The myth survives because size feels like legitimacy, even though discipline is the real qualifier. Another common myth is that profitable traders are always confident. In reality, confidence fluctuates. What remains stable is process. Experienced traders often report uncertainty before trades and discomfort during drawdowns. What separates them is not emotional steadiness, but behavioral consistency. They act according to plan, even when confidence is low. Trading literature emphasizes that confidence is a byproduct of disciplined action, not a prerequisite for it. There is also the myth that markets are manipulated against retail traders. While market structure is complex and unequal, this belief externalizes responsibility. It prevents learning by framing losses as unfair rather than informative. Trading books written by professionals acknowledge structural realities, but stress that profitability comes from adapting to conditions, not blaming them. The myth persists because it protects ego at the cost of growth. Perhaps the most subtle myth is that there is a final destination in trading, a point where struggle ends and mastery is complete. In reality, trading is a maintenance profession. Skills must be protected, routines renewed, and assumptions revisited. Markets change, and so must traders. The belief in arrival creates complacency. Trading literature consistently frames success as ongoing alignment rather than permanent achievement. Debunking these myths is uncomfortable because each one removes a convenient excuse. Without prediction, complexity, constant action, or emotional denial to lean on the trader is left with responsibility, patience, and uncertainty. Yet this is also where progress becomes possible. When myths fall away, trading stops being a fantasy of control and becomes a practice of preparation. And it is right here, when illusions are replaced with effortful clarity, that the real work begins and continues quietly forward. Even though the sentence itself has not yet fully come to rest, because once myths are dismantled, trading is stripped down to something far more demanding and far more honest. Without the comfort of shortcuts or fantasies, the trader is left facing reality directly, a reality built on probability, delayed feedback, and personal responsibility. This is where many people quietly step away, not because trading is impossible, but because it no longer promises to be easy. Those who remain begin to understand that progress in trading is not about finding better stories to believe, but about learning to function well inside uncertainty without needing it to resolve quickly. As these myths fall away, behavior becomes the central focus. Traders stop asking what the market will do next and start asking what they will do if it does not. This shift is subtle but profound. It replaces entitlement with preparation. Losses are no longer interpreted as personal injustice, and wins are no longer treated as proof of superiority. Both become data. Trading literature consistently shows that this neutrality is not coldness, it is maturity. It allows traders to stay engaged without being consumed by outcome. Another consequence of debunking myths is a new relationship with effort. Without the illusion that more work automatically leads to better results, traders become selective about where they invest energy. They review more and trade less. They plan more and react less. This efficiency feels counterintuitive at first, especially to those conditioned to equate struggle with progress. Yet over time, it becomes clear that restraint is not laziness, but skill. The market rewards clarity far more than intensity. Confidence also changes shape once myths dissolve. It is no longer borrowed from recent performance, external validation, or belief in a superior method. Instead, it grows quietly from consistency in behavior. Traders begin to trust themselves not because they are winning, but because they know how they will respond when they are not. This form of confidence is resilient. It does not collapse during drawdowns because it was never built on uninterrupted success. Perhaps the most liberating realization is that trading does not require perfection. Many myths imply that mistakes are evidence of inadequacy. In reality, mistakes are inevitable. What matters is whether they are repeated unconsciously or addressed deliberately. Traders who shed myths stop trying to eliminate error and start focusing on reducing its impact. This perspective transforms frustration into curiosity and blame into adjustment. Over time, debunking these myths also reshapes patience. Traders become less concerned with proving something quickly and more interested in staying viable long enough for learning to compound. They stop comparing their journey to others' highlight reels and begin measuring progress against their own past behavior. This inward focus protects discipline and reduces emotional noise, allowing improvement to unfold gradually rather than explosively. In the end, common trading myths fade not because traders intellectually reject them, but because experience makes them untenable. Reality replaces narrative. Preparation replaces hope. Responsibility replaces blame. And while this process removes much of the fantasy that initially attracts people to trading, it also reveals something far more durable: the possibility of building a skill through patience, structure, and honest self-observation. Trading becomes quieter after myths are debunked. There are fewer dramatic moments, fewer emotional extremes, fewer illusions to chase. What remains is work that is repetitive, sometimes boring, and deeply meaningful to those willing to commit to it. And it is precisely in this quiet, where excitement has been replaced by respect for uncertainty, that consistency has room to grow, and the trader finally begins to operate, not from belief, but from understanding.